So I'll be presenting joint work with the title that Simon already alluded to, which is Save the Banks or Save the Planet, Governing Through Strategic Ambiguity in EU Sustainability-Related Banking Regulation. And Simon also mentioned that this has been part of a larger research project. And what we're looking at, or what I'll be talking about in the next 20 minutes, is quite of a classical agenda that you see here. So I'll give you a bit of a brief insight where we are looking at. So we're not, we're looking at banking regulation and financial policies, so not specifically monetary policies, and at sustainability, and we'll briefly describe how this is being discussed in the literature, which analytical framework we chose, and then our empirical material that we ordered to 3 phases that also coincide with the policy process, the stages in the policy process that we found relevant, and I'll give you the summary and conclusion.
Nina, just very briefly, sorry, I think the presentation mode is not switched on.
This is always the problem when I have double screen. Okay.
Don't worry. Just thought I
Okay.
had to tell you before the presentation starts properly.
Yes.
Currently, you can still see your overall PowerPoint.
Okay, I will do something really quickly.
Yeah, no worries. We're good in time.
Okay. So let's see how is it if does it better?
No. Nope.
No, it's not. Okay.
Now we got it.
Okay. Okay. So we are looking at the intersection of, as Sima already said, of the banking regulatory framework that is preoccupied with safeguarding financial stability and has been reworked throughout the last decades. And the last one was in 2010, the Basel III agreement, after the big financial crisis that was often also connected, or there were many voices saying that too lax regulation in Basel II had been actually been reinforcing some of the tendency of the financial crisis of 2007-2008. And we have, on the other hand, the big Paris Climate Agreement in 2015, where actually Article 2 made the statement that it was an objective to make finance flows consistent with a pathway towards low greenhouse gas emissions and climate resilient development. And in the EU context, we have this combination of both tendencies, so banking regulation, and the question how to integrate or how to account for sustainability, with a statement by Frank Alderson, who is the vice chair of the ECB Supervisory Board, Banking Board. And he said in 2021 that banks need transition plans compatible with EU policies implementing the Paris Agreement with concrete intermediate milestones to enhance their long-term strategies and decision-making. And there's an interesting debate, and the debate that we also speak to with this paper that tries to make sense of what kind of approach has been become dominant in the EU, but also elsewhere. So we have a camp here that says, okay, there we see a clear discontinuity from a very market friendly approach. And these 2 authors, Jens van Kluster and Claudia Prodani, suggest that there's something emerging that they call alignment focused approach that is focused on the alignment towards a transition pathway to a net zero economy. And they say actually that's quite strongly allocative, forcing banks to lend in ways that reflect broader environmental policies. So this is one camp in the literature, and we have another camp that is much more critical. They say, so this is a paper by Cadward et al., that, for example, or there's other authors, but this is one paper that says that that there's a continuity of a risk-based governance, and that this continues to create favorable conditions for carbon-intensive assets. So there's much less of a steering element that other authors want to see. And the steering element rather relates to the big role that the central bank kind of plays in steering financial markets that are very unstable. So it has not so much to do with a bigger state, so to say, to break it down to this framing, but it's rather a high dependency on market forces that we see the central bank here intervening. And this is the debate that we speak to, and that the reconstruction of a policy process, we want to make sense of where if we rather with the camp of the discontinuity or the continuity. And so the literature has come up with this division of prudential and promotional approaches. And prudential approaches follow a risk-based and rational, and promotional ones rather follow a political one. And we found it helpful to further divide those prudential and promotional approaches. So there have been various publications that speak about now the ECB policies in COVID, in the climate crisis are promotional. They go very much into a form of credit guidance. So a policy paradigm that was more dominant before the EU integration, where you had an allocation to industries of credit. And what we are seeing now is kind of a modern version of it, right? And the camp that said, rather we stick with this risk-based approach, outline that there's this continuity, that banks still play a very relevant or the crucial role in deciding on how they evaluate the risk that they're seeing, so that not much of a political impetus is in there. And maybe important, I will highlight that the contribution by Van Klooster and Prodani made this relevant or interesting contribution, that they further differentiate the prudential approach. So they say, this like the critics or the skeptics towards the change that we're seeing may be right, that the policies that we're seeing are not promotional in the sense, they're not so political, but they have a broad conception of risk, right? So we're in this second column now. So the alignment-focused approach really says, financial supervisors can have a broader conception of risk, and this is what we are seeing in the climate crisis. So it's true, it's not a credit guidance as we had it, but it's rather this alignment-focused approach. And I want to also point you to the third column, where one could argue that there's also kind of a paradigm in the EU policies that is somewhat a small notion of promotional, because the EU doesn't have a fiscal budget, so it always draws on this regulatory approach to steer or to govern through financial markets, right? To achieve some political objectives through the approach of here in the sense, for example, lowering capital requirements to incentivize banks to lend towards green sectors. And the contribution we make is to say that we find that the introduction of the current sustainability-related financial policy approach in the EU was conditioned on an ambiguously framed risk narrative. So it stays in this realm of risk. And that this helped, that the ambiguity helped to preserve an element of credit steering in the first place, but that it ultimately hampered its institutionalization. I will say a couple of words about that in the conceptual part. And that thus the current policy approach is neither a simple continuation of existing prudential or very narrow risk-based approaches, but it also doesn't mark a substantial divergence to it. So we're quite critical with regard to this allocative potential that the authors Van Klooster and Prodani, for example, see. And I'll give you having a bit trouble of getting the next slides with my various keyboards here. Let's try out this one. Okay, so this is our analytical framework. I will just go briefly through it because we'll come back to it, but it's based on Bob Jessop's factors in semiosis and structuration, and we integrated Jacqueline Best's notion of governing through ambiguity into it. And these are different factors when existing discourses are challenged by a crisis, and the different forces work towards either bringing up a new discourse that becomes then hegemonic, or a kind of a reiteration, or a kind of a sedimentation of the discourse as it was, with a slight adaptation. So this is a process of variation, selection, and retention. And one could say that certain actors want to implement or want to have their discourse become dominant. And what we add here with this ambiguity is to say there can also be an advantage in leaving the meaning of something open. And we'll come back to where this played out in the political process that we analyzed of the integration of sustainability into EU banking regulation. An approach was based on an analysis of 30 interviews. We analyzed various documents, and also 3 public consultations. And we now present to you the empirical findings with these 3 factors, or 3 stages of variation, selection, and retention. And in 2017, the commissioner of FISMA announced, Valdis Dombrovskis announced that they wanted to introduce a so-called green supporting factor, right? And his reasoning was that to reach the target, so the Paris target, we will need around 100 billion euro in additional low carbon investments. And to incentivize lending, we are looking positively at a proposal to amend capital charges for banks to boost green investment and loans by introducing a so-called green supporting factor. So this was kind of the starting point of how sustainability was discussed in the EU. So it was in a sense of, okay, it's an investment opportunity and we want to support banks. So we see this as the first, the promotional discourse that came up. But this promotional discourse was quickly challenged by financial supervisors, and also by some NGOs who are critical of kind of lowering capital, because the capital is relevant if loans fail, that the bank then can pay the amount itself and doesn't have to rely on the state. So this is was kind of the concern that some actors can have, that we can call the prudential camp had. And what is interesting in this first phase is that we kind of have there's kind of a dichotomy. And it's also a bit torn, this dichotomy, and I will try to explain you why. But I first give you this quote by an institutional investor who was involved in this discussion in the first phase. And this institutional investor says that the reason why the green supporting factor and the dirty penalizing factor became political was that it wasn't presented as a financial stability argument. So there was a big pre-prepared fight back, that they were not within the financial stability community, that the purity of their work was being tarnished by political reasons. So what happened in the first phase is that you had a dichotomy emerging between, on the one hand, the so-called political approach and then the prudential approach. And the interesting thing is that financial actors were able to portray a dirty penalizing factor, which is actually the opposite of a green supporting factor. So it's increasing capital requirement, as kind of in the same realm as the green supporting factor. And that meant that the prudential discourse was a very narrow version, right? So because already at that time you could have argued that because it's carbon-intensive assets that will become stranded or that have a higher risk, a higher climate-related risk, they should lead to the fact that banks should be better prepared to pay for it once these assets default. But this narrative wasn't there at the moment, but we had kind of this dichotomy. And on top, we had the tendency that, or on top of that, the policymakers also struggled to actually get support from the financial sector itself with this green supporting factor. And this is quite interesting. This is the consultation. And here banks were with 41% in support of a green supporting factor, but also 35% were against it. And that's quite interesting, right? Because if you want to incentivize banks, they should actually be supporting it. And what we found in the evaluation of the consultation is that that first, also the ones that actually support a green supporting factor were a bit critical of it because they said, but we would still have to have a risk assessment. And then if the risk is low and it's also green, then we would be pro a green supporting factor. But then it actually kind of eliminates the purpose of this policy, namely that it just incentivizes green a bit without regarding the risk aspect of it. And there was also a fraction that were against the green supporting factor, which we interpreted partially as a strategic argument, because as we've seen before, that there was this framing of the political approach, which entailed the dirty penalizing factor as well as the green supporting factor. So if they said we are against the green supporting factor and they could also say we are against the dirty penalizing factor, with the effect that they wouldn't get penalized for holding carbon intensive assets. So this was the first phase. And then in 2021, as this whole thing progresses and first sustainable finance legislation is on the way, we have kind of a reframing. So we have here at the Commission that the Commission gets a lot of criticism on its approach of the green taxonomy, the so-called EU taxonomy for sustainable activities. And this is from ChatGPT, but this is kind of to say the taxonomy is only really like a fraction of economic activities, but what do we do with the rest, with the rest of it? And so the Commission comes up with this framing of a transition, and also in this renewal of its strategy. And then we have the kind of a turning point here where the ECB makes an assessment of whether banks are somewhat Paris aligned or not. Or if they have, if they're Paris aligned, but if they have risk management tools in place. And this evaluation finds that they don't have a lot of tools in place. So the ECB shifts from being let's stick to the way we are and gets a bit more concerned. And have this framing of the transition plans, which the quote that I showed you in the beginning, where Frank Ellison announced that they should introduce those so-called prudential and transition plans. And interestingly here, we found that the ECB actually started integrating a bit of a steering element into its approach. So it wasn't, this was really a moment of realization, okay, maybe we can bridge these dichotomies and overcome this political impasse by suggesting an approach that is kind of integrating both perspectives. So this quote says, Frank Ellison took a very strictly prudential perspective in what he said, always framing prudentially, but I'm 100% sure he knows that he's playing an ambiguous game. Eventually, what he cared about was not the risk in themselves, but pushing the banking sector to do something promotional, to reallocate credit. And this tool of the transition plan, the prudential transition plan, was one of those endeavors to kind of, well, as this quote here says, to have this prudential narrative, but actually to have a different, to have an objective that before the policymakers had been advocating for, which is means to allocate credit to more credit towards green sectors and also withdrawing credit from carbon intensive ones. And the last phase of retention, and this is where we show that this ambiguity has also its downsides. We have various instances where where then Frank Alderson and the ECB had to kind of pull back from their quite big statement that banks should be Paris aligned. Because what Paris alignment would mean that actually each individual bank would be with its emission on the transition path from now on to 2050. And this was something that a lot of supervisors went against. So they said we shouldn't have any, that shouldn't be made the mark of banks' investment, whether their portfolios, overall portfolios is aligned. This is not a risk-based perspective at all. And we have another quote here where this struggle and the kind of narrowing down again of this alignment-based approach that Alderson proposed comes through. So this quote says the concrete functioning of transition plans was not fully thought through. There's a tension between Paris alignment and the thing that Alderson started pushing, and then they tried to reframe what we mean with transition plans is that you need to have the risk under control. So they kind of made it a risk interpretation, right? And this code kind of says it was not really thought through from the beginning. It was a proposal that really served to make a compromise. So to push banks on the one hand, but also to make a compromise in this realm where there was opposition against sustainable finance. And we have other players here that I didn't have in this presentation so much, but it's more in the paper, that are much more critical with regard to this broader stance that the ECB was pushing. So we have a quote here by another EU financial supervisors who says something like stranded assets. It's a catchphrase, a buzzword. Who's going to have those stranded assets? Those big companies, they don't really care. And is that going to change the credit risk? There's no evidence that this is actually going to happen. So if we speak in this, if you remember the financial typology, we are very much then only in the left column, which is the so-called differential riskification, where it's not very much determined by the financial supervisors, and there's a very, very little element of steering in that, to say it shortly. So almost coming to the end, our argument is that in the beginning, the promotional and the prudential discourse ran in parallel, and that then the concept of the transition facilitated the selection, and that then the prudential discourse superseded the promotional one through the proposal then of prudential transition plans. But then prudential transition plans, I haven't had time to give super in detail what they are, but the ambiguity that this proposal had kind of relapsed, right? So we want to show that it's a very contested area of regulation, and this is why this ambiguity, you could argue, is so needed. But then in the end, the strategy the ECB and others have been following is kind of relapsing. This is again our three claims. I won't read them out now because of time reasons. And just to conclude, so what's the problematic, or what are the consequences of what we have been seeing? So our argument is that there's still quite a big reliance on, the banks have a lot of discretion in choosing. So these prudential transition plans, they can actually choose the alignment scenario they're choosing. So they can align their portfolios with a 3% degree rise in temperatures. They can do it with 1.5. So they have a lot of discretion because financial supervisors don't want to fix that. And we say that there's a competitive struggle between banks because, well, you just lose if you take a stricter approach because still currently carbon intensive assets are have a much lower risk and green ones have higher risk. So this is also the thing why there's why steering was considered in the first place. We have second that we want to show. This is the point that we couldn't make so much strong it's here in the presentation, but that this transition framing is also something that really blurs the line. So you cannot say anything. You don't say anything about brown anymore or dirty sectors, but everything is a transition. So even fossils can be transitioned. The automobile industry can be transitioned by 2049, right? So you can wait until that point and say, yeah, sure, they will transition, but it's actually kind of a very blurry concept, and it has an influx of or influence of industry influence. And third, actually the very active role that supervisors have been taking from the analysis that we portray can also be problematized to a certain extent, because there were various instances where the policymakers, not idealizing them, but they had kind of an intention to integrate the taxonomy approach, so an approach that has takes prevalence as a prevalence the ecological criteria and then plug the financial ones into it, but with a prevalence of ecological ones. They had such thing in mind, but this is something that then was sidelined by the supervisors and this approach, the prudential transition plans approach. Thank you very much. Yes, that was it. And I would, yeah, maybe give directly over to Julia.
Yeah, perhaps just, yeah, exactly. There's no other points, then we can proceed. You may share your slides, I think.
All right, so I will step in. Unfortunately, I don't have slides, but I will try to make it still where and the team for this very thought-provoking paper. I think I could speak a lot, and there are so many different things to discuss, especially taking the view on both the knowing how the regulation is structured, how it evolved, but also considering the political economy of all of this, which was a substantial part of the paper and which I can definitely also talk a lot about, because over these last 5 years, as the rules have been in the negotiation, when we went along with the ideas of from capital requirements to transition plans, and we really saw it in many, many conversations with the parliament, with the member states, with the supervisors, how this discourse indeed evolved. And I think there is still a lot to be said of what comes next, because indeed we are still in the situations where we can go both to, as you were saying, to reopening the selection or facilitating the retention. So what I will try to do, I will speak a bit about why the narrow or even the broad prudential approach turned out to be insufficient to address the issue, even though there was a lot of hope on that. I think especially once the McCartney made his speech about climate risk being a financial stability risk, right? And there was the realization that now finally the existing prudential regulation can help address it if it's a risk. So I will talk a little bit about that and also reflect on how the nature of climate risk actually facilitates us to depart from that, and even reflect on the validity of the existing prudential approach as it is designed, as it is ingrained in the framework, as it is being used by financial institutions. And we'll also, I would like to ask the question, so where do we go next from this? Indeed, so can we evolve the prudential approach, or can we go beyond that? And what would be needed to go beyond that? Eventually, it's also a democratic choice, if we can call it like that. But of course, that democratic choice is not at times fully democratic. And I would like also to reflect a little bit about that. And I'm happy also at the end to talk and give you a few insights of what is happening now as we are seeing it from our position, engaging with the supervisors who are still doing this work, but also engaging with the legislators in the current political agenda. And I think it's, of course, very relevant to consider where we will go and what will happen. Will we be able to eventually address this risk? So I will start with the prudential regulation as it is, and I think why eventually it turns out to be insufficient. So as Janina was saying, the current prudential framework, so the risk-based framework, has been largely brought into its current form after the global financial crisis. And it also, not only because of that, but also because of many, many other developments, it is strongly based on the risk perspective, for the good reasons, I would argue, because the financial crisis kind of has shown how important is financial stability to the whole economy and the society, because when financial stability is not there and when institutions are not capable of managing their risks, this brings huge cost to the taxpayers, right? So the first task was how to make sure that these institutions are eventually do not drag the whole society and the economy with it. So there was a need to construct this framework in that way. However, because of the many developments historically, and because of course, the need to simplify somehow the whole reality into a bunch of formulas, right? So that the banks have a chance of managing all of that, and the supervisors have a chance to supervise. We ended up with the framework, which is quite specific and is mostly better capable, I'm not saying really capable, but better capable of dealing with the risks, which are kind of functioning on the premise that the past is always the future is always going to be like the past. So it means that the rules which are included in the Basel framework, which are used by the banks, they are mostly taking the historical data to understand what will happen in the future. They are also strongly using mathematical and statistical methods, which of course will not allow to project too much in the future because it becomes increasingly uncertain. So most of the models which speak about what is actually risky operate on a 1-year time horizon. Also, because of all these simplifications, it leads to the need, of course, to abstract, right, and to fit a reality into some kind of an abstract picture, which leads, of course, to the fact that financial system becomes almost like a world in itself, and the risks become only mathematical. So it really leads us to the departure from a lot of interactions between finance and the environment in which it operates, most importantly from the natural sciences. So in this context, things like environment and climate, they are treated as a simply externality and very quickly kind of pushed away from the prudential framework because they have to be dealt with by taxes or something else. So increasingly, of course, with the kind of combining these two frameworks, as Janina explained, after the Paris Agreement, and with the realization that now somehow climate risk needs to be recognized as risks, we started increasingly hitting the limits, right? Because we could, like, it's very clear that climate change is not found in the historical data, that looking just into 1-year time horizon will not lead us to see any risk in there. So this increasingly led, of course, to kind of reflect on if our prudential framework is even capable of managing this risk. And of course, it is not. And I think this is where we kind of went into this analysis paralysis, where we could not move further. And it increasingly became necessary to extend the approach on the understanding of risk. And I would argue that it led exactly to this kind of elements of kind of as if steering elements. But if we really reflect on what climate change is, the risks that it brings, but also the radical uncertainty that it brings, because a lot of the things, of course, they cannot be described with the traditional concepts of risk, and they have to be described with uncertainty, which can be radical uncertainty, but also uncertainty in terms of let's say game theoretical uncertainty, because addressing climate change requires simultaneous actions, in sync actions for many economic actors, including the financial system. So we kind of went to start, and a lot of supervisors as well, they went to reflect on the broader concept of what is a risk. So extending the time horizon, realizing that what we do today will influence the risk in the future. So the past dependency. And And this is why I think, and we've contributed a lot to those discussions ourselves as Finance Watch. This is how we ended with trying to design some still like risk tools, but which would account for these elements. So this is how we went into prudential transition plans discussion. And at the moment, we are also discussing a lot with the supervisors, which is still a topic, the tools which are in the prudential framework, which are macroprudential tools, which are designed to address the forward-looking nature a bit more, and also which are designed to have some preventive component. But we also see the limits of that, because this is where we exactly have the clash of very kind of neoliberal orthodox views on all of this, which really want to abstract from anything which is not fitting the existing framework, and the views which like ourselves represent so much more is asking the question, how do we need to evolve the framework and evolve the tools to make sure that they are still for purpose, and the purpose is obviously to guarantee even the financial stability. And from this perspective, I think we need to also understand that at the end, addressing climate change is in the interest of also the financial stability, right? So even if we are still in an extended prudential view, I would argue that we still need to do much more, because it is kind of the stability objective and the risk management objective are still there. But of course, I think we could also have a discussion, and it's a very legitimate democratic discussion, if we want to be content with that, right? Or if we want to say that, well, actually, it doesn't matter. It doesn't matter, like, if I can find the perfect evidence in a very classical quantitative view to prove that this is stability, but because we know that this is a huge risk, and we know that there is no future neither for economy nor the financial system if we do not address climate risk, and have like a very explicit, stronger kind of allocative element to all of this. I think it is, again, it is a legitimate ask, and it is a legitimate discussion, which, however, I would argue also necessitates a broadening the view to the different parts of policies and regulation that we have, to make sure that just by tweaking one element, we do not kind of jeopardize, or we do not have an unintended consequence somewhere else, right? Because the objective of having a robust, safe and sound, as the regulation go, financial system is still very important. And if we will not have safe and sound banks, we will also not be able to support the transition. So if we explicitly introduce even steering elements into prudential regulation, we need to still make sure that this prudential regulation fulfills its primary objective, and that we do not, let the banks kind of a small backdoor then to run the risk. I think it needs to be a very democratic discussion. However, what I also think is quite problematic is in that sense, and it relates to a broader issue at stake with the financial systems, that once we start going into that discussion and have reflections on the functioning of the financial regulation, we run into a lot of political economy issues here, and we ran also into the debates which take place at the political level, with the participation which is very unbalanced due to, among others, the complexity of the rules and the complexity of the financial system as it is. And we see, because we are part of many of these discussions, that they are largely dominated by the financial industry. And I think this is also the path which I think in the group that we are here, we would like the discussion that we would like to have. But I think we have to be also very conscious that this debate is likely to be dominated again by the powerful players. So we would need to make sure that there is a lot of let's say, really democratic representation, which is again difficult because of the complexity of these issues. And what we have also seen, for example, last year when we looked into the debates around the European elections and different political parties and their programs, including if they address this type of issues, we saw that in very, very few cases the issues or the questions related to the financial system and its functioning even entered the democratic debate. I feel that we also need to solve this important element, and not only, of course, the way we want to address the regulation. And before I talk too long, just a very, very brief snapshot of what is happening now. So now we have effectively still the work ongoing on the question if there will be any capital requirements to address climate risk in the prudential frameworks, which are unfortunately not very promising at the EU level, because there is an important interaction between the EU and international level due to the Basel standards being global ones, and we know that the Basel cooperation is unfortunately at risk because of after the kind of United States completely changed their political stance around it. A lot of work is essentially blocked, and we see the reluctance of the European legislators and supervisors to act there, because they largely succumbed to the banks' narrative now that this will be detrimental to the competitiveness. So there is a lot of political capture in there. However, on the aspect of prudential transition plans, there is still a lot to be indeed decided. We see very clearly that now is a decisive moment, which will determine if we will really go to kind of like retention of the concept that alignment and that alignment is effectively in the interest of stability and has the place in the prudential framework, or if we will see a bit of a departure and the rollback of what we have achieved towards a much, much weaker prudential approach. Whereas we also do see that some of the supervisors are telling us, well, now we are finding ourselves in the position where we need to go back to the drawing board and prove that climate change is financial stability risk, not using the climate science, which is very clear, but using the exact formulas that we are used to work with, which is, of course, I think, a dead exercise. But I'm happy that you are all interested in this topic, and I'm happy to stay in touch because we are actively intervening on that debate as well. Thank you.
Thank you so much for actively intervening. And I'm looking forward to the debate afterwards. I would very quickly pass the word on to Lydia and ask you if I may share your slides, and you just give me a heads up once I should change it. Yeah? Okay, great. Then floor is yours, Lydia. I'm just gonna share your slides very quickly. All right, go ahead.
Great. Yeah, these are just some very simple slides to guide the discussion. But yeah, thanks so much for the invitation. I'm Lydia. I'm a research fellow at UCL. Had the pleasure of meeting pretty much all the members of this research group at various conferences last year, and had some really fascinating discussions. So really happy to be here. And so I'll be structuring this presentation in a kind of typical academic discussant style. So first summarizing the contributions of the paper, provide some relatively brief comments, because I think the paper is honestly excellent, and I guess some broader questions that have come up for me when reading the paper about the future and implications of transition plans in banking regulation. So for me, the paper asks the kind of following research questions. Why has the EU sustainability-related banking regulation landed in the state that it is, which is namely prudential transition plans as its main tool? And then I guess a more normative or argumentative angle about what is the potential for the regulation to have this steering potential, and how has that potential been driven by the policy process itself, rather than these I guess ideal types of regulation that we may be imposed from academia or the policy space. And so on the why, I think they argue that essentially these transition plans were developed as a relatively ambiguous policy tool to sustain the possibility of credit allocation, and this possibility was supported by civil society, some aspects of the European Commission, and also incidentally part of the ECB. And I think something that's super interesting in this paper is how the ECB seems to have shifted its position on this topic. I'll discuss that later. Also, feel free to timekeep me because I'm aware I've got 10 minutes. whilst essentially appealing to other factions, so the EBA, banking practitioners, and also the kind of structural embeddedness of this prudential approach within the organization. And I guess the position that we've ended up in now is that this, while they've kept the tool ambiguous, the discourse that they've selected was very unambiguous and lied very much on the prudential side. And essentially, this has already foreclosed the potential of these tools to deliver this credit allocation by embedding them within Pillar 2 and embedding them within this highly deferential approach. And so the main contributions of the paper are first this analytical framework showing how this idea of ambiguity can help advance regulatory change towards one rationale while maintaining many actor interests, but that same ambiguity can then hold back the embeddedness of regulatory change, perhaps in the way that the regulators have envisioned it explicitly or implicitly. It reconstructs the process between 2017 and 2015 across a really diverse set of actors, including its interaction with other parts of the EU sustainable finance agenda. And it provides, an empirical basis that I guess, pushes back against a more hopeful approach to prudential transition plans by other parts of the literature. Essentially, as I said, by suggesting that the mechanism through which the policy process proceeded has already foreclosed this possibility of meaningful allocation. And so we're essentially in a not in a meaningful credit steering position. So next slide, please. I found the analysis in this paper really fascinating. I think especially as someone who now sits in academia, but previously sat in the sustainable finance civil society space, and looking at these kind of unexpected positions and alliances, for example, both civil society and banks being against the green supporting factor. And I think it really importantly shows that the politicization of green central banking is deeper than the structural pressures that central banks experience as a kind of homogenous institutional bloc, which I think has been emphasized by some of my colleagues, Katie Kedward and Josh Ryan Collins, and how there is like contestation within this institution itself, so within different parts of the central bank and its delegated authorities, between the bank and the supervisor, and also really importantly the role of individual bureaucrats in advancing change, especially the likes of Frank Elderson, and that's really interesting for people at IIPP who sometimes study this role of bureaucratic innovators and what they can achieve. And I guess what the case study shows is that these innovators can only go so far amid these structural constraints, and sometimes the compromises that may appear strategic at the time can ultimately constrain the transformative potential of the regulation. And it also shows, the tensions in applying these ideal types we come up with academia against the real world, which ultimately like mixes up all these different tools and rationales in different ways than we perceive them. And so I had 3 comments on the paper, one of which I think you've actually discussed already really well in this presentation, but I guess emphasizing why allocative policy, why central banks desire these allocative policies or discretionary policies, and why we as citizens or kind of the broader economy would desire these. And I guess it sits between this risk perspective. So within the current hierarchy of goals by central banks, their risk perspective is like analytically and methodologically limited by the fundamental uncertainty of the green transition and of physical risks. And so while they're very, very focused on wanting to measure these risks, they essentially know that they need different tools. But as my colleague Katie has argued, in doing so, in moving towards these more discretionary tools, they necessarily get led down the path to allocative and discretionary decisions that politicize the process and hamper it without necessarily that being the intention. And that seems to be some camps on the prudential transition plans, and definitely some camps in terms of the greening of monetary policy, where different risk management tools have come up and they become intensely allocative. Whereas this more transformative potential kind of does away with the risk measurement at all and tries to subordinate central banks through their power over money and credit towards wider policy goals. And it seems like I guess there's a like methodological versus transformative argument, and some camps in the ECB seem to fall more on the transformative side. And something that I was thinking about is whether there are different allocation potentials between these tools. So I think there's a clear preference within this paper and to a certain extent within the movement for Pillar 1 tools or capital requirement tools to be applied in this granular climate adjusted way because this systematic approach prevents the kind of gaming by the system. However, there are constraints to the strength of these tools. So I've done a bit of policy research on this. Their kind of pass through to the economy of capital tools is very dependent on the financial position of banks, and even then is relatively moderate. And the taxonomy approach, if done in this sectoral basis, the impact could be very minor for clients that are diversified. So things like oil majors, where a small percentage of their tax, if we had a harmful taxonomy, the kind of impact on the capital position of the bank and the financing of the company could be very minor. In contrast, because transition plans are much more holistic and business model wide, they include non-balance sheet divisions like capital markets facilitation, like private lending, so some of Simon's work. In a strong form, they could be much more allocative across a wider set of industries and financial activities. And while this, I think, holistic approach makes them a much better tool for the realities of how damaging activities are financed, it also makes them much more susceptible to this weakening by vested or orthodox interests. So there's kind of a tension here in terms of flexibility and nuance that's needed and how this makes them vulnerable. And the UK transition plan requirements that have been developed by a kind of government task force are a key example. They're so vague, they don't really say anything, in my opinion. I'm aware of time, so I actually am going to skip my second one, but we can discuss it later. But yeah, I thought the analytical framework would be really interesting as to how a novel to extend how this could be applied to other cases. And there are other kind of unsolved puzzles in the literature that I think it could be really helpful in. So, for example, in the UK, the bank was a leader on the Bank of England was a leader on climate change from 2015 to 2020, and it was really quite allocative. And it shifted in the past 2 to 3 years to actively talking down its climate approach externally, actively slimming down capacity, even on the risk management side, and making a kind of big political song and dance about this. And this arises out of a combination of structural factors and political factors, like inflation and the resulting politicization of the central bank in the UK, which I also think is something to do with its closeness to the domestic economy, whereas the ECB is obviously slightly distant from the domestic politics of all the countries in the European Union. And I wonder what implications that has for the flexibility that it has. But I think this would be an interesting case to apply the framework to, because it also has this combination of structural factors and actor strategies. So we moved from a governor in Mark Carney, who was progressive, to Andrew Bailey, progressive in a way, to Andrew Bailey, who was regressive. We moved from a populist, pro-climate Prime Minister in Boris Johnson to a regressive, climate-cautious Prime Minister in Rishi Sunak. We also hosted COP, and we had a very active CSO movement on the Bank of England. And yet now the political climate has shifted to be very favourable on climate. The bank has remained very constrained by these structural factors and hasn't shifted despite actually quite a lot of pushing from government on climate and biodiversity. So yeah, interesting other case study. And then I guess some broader reflections are, does a apolitical alignment-focused approach exist in a form that could be successfully implemented by a central bank within this prudential framework? Both the pathways and the tools to measure banks against the pathways are inherently political. Their design entails political decisions, and especially the tools to measure banks' progress can be gamed in certain ways. They exclude certain aspects of banks' activities, and so these in themselves are not neutral. And then something that's interesting in my work, because I work a lot more on nature and deforestation, is whether there's discussion in the interviews or in future work on the international dependencies within alignment, how for many large banks in the UK, it's not possible for them to only align with the EU's climate strategy, but also with the transition across the world, including in global south countries. And while I think for climate, this can sometimes seed into the background when it comes to nature, this really comes to the forefront because much of the world's biodiversity is in global south countries whose economies are very tied up with the sectors that you would want to penalize in a kind of more coercive, active approach to dirty financing. And so there are kind of justice and also kind of dispute issues there that have been mirrored in the European Union deforestation regulation, which has been very, very contentious. So an example of the EU trying to constrain its international environmental footprint and that leading to big political battles. And then I think the original, when I first saw this paper on a conference schedule, I think it was a quote saying, "Who are we to define what a good transition plan looks like?" And I think that's really stayed with me. And so I really liked how you ended the conclusion talking about the need, if credit guidance was to be taken seriously again, there would need to be this development of proportional institutional capacities. And so I was interested if you thought about what those look like and what kind of coordination it would require.